Hello, everybody. Today we are going into first-time home buyers and what you need to know from our mortgage specialist, Colin Mason.
Great. Thanks for having me. How are
Yes,
you?
yes, I'm good. Thank you. I'm good. So, Colin does a lot of work with us at Remax Prime Properties. I have some questions today about first-time home buyers specifically, Colin, if you wouldn't mind spending some time with us. And we'll get right into it. I want to ask you specifically first about credit scores and credit ratings for first-time home buyers.
Okay.
What's ideal?
There is a lot of latitude when it comes to credit in general. Typically, we like to see credit scores of about 680 or higher. There is a little bit of latitude when it comes to the actual score. One thing that people aren't aware of is that your credit score is not necessarily the only thing that the banks look at with respect to your credit worthiness. They take a look at patterns. Your credit score does monitor your patterns. Where do you spend? What are you spending? How much money are you spending on your available credit? How much credit is revolving versus fixed? That's if you have a line of credit or a credit card versus a loan. So
Oh,
they take all these things into consideration. And your credit score sometimes doesn't necessarily reflect. I've seen people that have lower credit scores but have really good credit. And then I've seen some people that actually have some shaky credit, but they have a really good credit score. So the banks look at everything as a package.
okay. Is it true that your utilization of, say, a credit card, does that affect your credit score? When I say utilization of your credit card, if you have a credit card for $10,000, but you continually only use 10% of it a month, does that increase your credit score if you have a low utilization?
Yes. When you pull credit inquiry, we've seen people that have, we pull a credit inquiry on them and they've paid all their credit cards off to zero, and then they've used the cards, and for whatever reason, if it's been a long time since we took their application, we have to pull another one because they expire when we submit them into the lenders. So sometimes the lender will say we need you to pull a new credit inquiry. If they've gone out and utilized some of that credit, then we see that the credit score goes down. Again, depending on how close, if you have an 800 beacon score, then if you utilize your credit a little bit, it's only going to impact the numbers marginally. But if you're right on the line, if you're at like a 680 and you utilize, your credit score may drop down below 680, that could impact your ability to get your mortgage approved. But just to address your other question really quickly, we always recommend paying your credit cards off monthly. That's the best way. Obviously, it's not always feasible. Try to avoid using more than 50% of your credit limit at any given time. These are little strategies that we always tell clients, little strategies on how to manage their credit to tweak their credit score.
Oh, okay, good to know. Try and keep your utilization under 50% is ideal and pay it off monthly. So, say you have 1 or 2 months in a year that you had to put the minimum down. Does that affect it?
It's, I always say it's like a wound. It will heal, right? So if you do something that impacts your credit score and your rating goes down because of your credit utilization, maybe you couldn't pay that credit card off. Maybe it's a large purchase, so it went over 50% of the limit and you had to carry it for a couple of months until you could pay it off. That will impact your credit score, but then what do you do after that? So are you able to repair your credit by paying it off monthly? So a couple of months of paying it off right to the end of the month and only using less than 50% will then again move your credit score back up.
Okay, good to know. All right. Are there any big mistakes that a first time home buyer might do with their credit that might damage their credit before purchasing a house that you've seen?
Yeah, we get a lot of that. We've got somebody that people that say, I'd like to get a pre-proof for a mortgage. So we pre-approve them, we go through everything, and then they go out and buy that new car they wanted. Or the big one is furniture, especially for first-time home buyers, because they don't have a lot of furniture. So they're thinking, okay, we've got pre-approved for the mortgage, or we've been actually approved for the mortgage, and everything's ready to go. And then they go out and spend $20,000 or more on furniture and appliances and everything else. And if the bank for whatever reason does need to pull a credit inquiry, we've had some people say, oh, is there any way we can increase the mortgage, or maybe we move their mortgage to another lender to get them a better rate, and now all of a sudden their credit score is lower because they've incurred all this debt. So
Right.
I usually encourage people just to lay low for a little while once the mortgage is approved.
I've heard of a story where one of the clients final few days before closing, and they went out on the weekend and got married, and she changed her name. And all the
Yes.
paperwork was already done. Beware, don't change your name once you started the process. Just wait till
Yeah.
after it closes.
Yeah, it does. Any material change to the application, you always think the banks are approving you based on a point in time in your life. So the less change you incur prior to your closing date, it is not a bad thing for you to do it. It just means that there's administration that has to take place and paperwork.
Yeah, as long as you give everybody a heads up so that we can change things. Okay, you're pre-approved. That pre-approval can last for what? 4 months? 6 months?
Yeah, a rate hold. So typically, a pre approval really is just a rate hold. Now, some lenders will do a full pre approval, which means they verify your income, they look at your credit, they do a deep dive into the application, and that's a full pre approval. A lot of banks and lenders have stepped away from giving that deep dive pre approval just because if they spend a lot of time on pre approvals and only 20% of them actually materialize into mortgages. So they don't really want to spend that much time on doing pre-approvals. That's why it's good to deal with a mortgage broker because we know what the banks are able to do. So we can give you that pre-approval for the comfort. Typically what we do is send them the pre-approvals in for the bank. The biggest value that they add is that they do rate holds, and rate holds last for about 120 days. I would say that pretty much 120 days is that benchmark of where we'd have to relook at the numbers afterwards. Again, if there's any material changes to your situation within that 120 days.
Okay, got it. Now you touched on the difference between using a mortgage broker rather than a bank. Mortgage brokers, just to be clear, can use banks and have access to banks typically, as well as other lenders. What's the advantage of using a mortgage broker like you rather than just going to your neighborhood bank?
I always say to clients, the difference is that I don't work for the bank. I work for you, the customer. So my job is to make sure that the customer is happy. So we shop your mortgage around behind the scenes. We do all the legwork. We save a lot of time. We only pull one credit inquiry, and then we are able to go to the various different lenders and say, here's what we're looking at. So we do a lot of the stuff that it would take a long time for the customer to do on their own. Obviously, as well, we have lots of promotions that are given to us by the banks because of the volume of business that we do with them. So they say, you know what, we're going to do this deal for you because we know all your clients are very good clients, that kind of thing. When you go to a bank, there's the timing issue because you have to start the process again with each lender. We have access to lenders that customers don't have. There's lenders out there that they may not have even heard of, and a lot of them offer better rates than the chartered banks. And I just want to correct you just to make sure I don't want to give any information that's not 100%. We don't have access to every single chartered bank. But what I personally do, and I know a lot of good mortgage brokers do this, is that if for whatever reason it makes sense for you to go to a lender that we don't deal with, let's say, for example, a client has a mortgage with a particular institution, and for me to move that mortgage over to deal with a lender that we actually deal with, it would not be the best thing for the client. We always will help them renegotiate their mortgage with their own bank, that even if that bank doesn't deal directly with the mortgage broker. And there's only two chartered banks that don't deal with the mortgage community formally, which is Royal Bank and CIBC. Those two do not deal with mortgage brokers. But I frequently call up and help clients in CIBC and Royal Bank get the best mortgage with them. I don't get anything out of it other than client satisfaction.
Wow, that's amazing. We'll touch on why they don't participate another time, but that's interesting. Okay, pre-approval to closing day. What can happen other than me going out to get a car loan or making a mistake as a purchaser? What can happen with things like appraisals? Can that ruin the whole purchase? And when do appraisals get done?
Yeah, that's a very good question. Appraisals are done after the approval process because we can't do an appraisal on a property. We don't know what property that is yet. We are finding for a purchase, they generally come in at the market value, unless somebody's spending a little bit too much, like a multiple scenario where they pay a little bit more because of bidding war and they end up paying a little more than market value. Appraisals are coming in a little bit lower, but typically for purchases, And for the sake of this phone call, we haven't had too much of an issue with the appraisals. Now, also because I know you're concentrating on the high ratio, the CMHC style mortgages, CMHC takes care of that side of it. So generally, there's not an appraisal required.
Okay.
So that's just something to keep in mind as well.
Okay, that's interesting. Just so everybody's clear, you get a pre-approval, then you go house hunting, you find the house, you actually want to put an offer in a specific house. That is the house that will have to have the appraisal done before the mortgage firms up. So this is where you can, if you overpay on the house because of bidding war or something, it might not appraise at what we are offering to the seller. So we have to be careful there. Typically, we put 20% down on the price of the home, but that's not necessarily the case all the time. You can put less than 20% down if the house is less than 1.5 million. Can you tell us what happens if I don't have 20% to put down?
Yeah, I'll just segue into that just on what we were talking about earlier. A financing condition is very good if available. I know that's usually something that you would recommend for a client. We're seeing a lot more financing conditions that will cover you and protect you a little bit with the appraisal process. We usually can get the appraisal, or the CMHC will give the approval within that financing condition period. So that's good. So if you put less than 20% down, a lot of people can't, because not a lot of first-time home buyers have the benefit of putting $200,000 down on a property. So it's quite common that we see people putting less than 20% down. It's broken down into tiers. You don't have to follow the tiers. So it's 5, 10, or 15%, but you can put 8% down. You can put 6% down. It does get a little complicated over $500,000. So the percentage of how much you have to put down increases after the $500,000 threshold. Again, maybe at a different call, we can get really more detail on that. Yeah. There's a CMHC, or a high ratio insurance premium, that's calculated based on the amount of the down payment, and that premium is added on top of the mortgage amount. You don't actually have to pay the premium in one lump sum, because they can get pretty hefty depending on how big of a mortgage you require. It could be $20,000, $30,000. So that's added on top of the mortgage after your down payment is calculated. Basically, the way it works is that you can put 5% of the first $500,000 down and 10% of the balance. So $1 million, you'd be putting $75,000 down. Also, the banks need you to have, or at least show that you have the ability to have 1 to 1.5% of the purchase price available to you for closing costs. Now, this causes a little bit of concern, because some people say, but I'm a first-time home buyer, I get the land transfer rebate and all these things. It doesn't mean that it's going to cost 1.5% for your closing costs. They just want to make sure that you have it available to cover you just in case.
Got it. Okay. So 13% down on $1 million home, $130,000. I would have to have CMHC insurance on that mortgage because it's not 20%. So if we do the rough math, that insurance premium would be around 26,000. Is that correct?
Yeah. If you want on a call, what I can do, I'll give you a screen and break it down. It's on the website that shows all of the different costs.
All right. So that premium goes on top of your mortgage, and then you pay it off in your 25 years or whatever, 30 years.
Exactly. To make it real easy, let's say you had a $900,000 mortgage, and your purchase, whatever it worked out to, you ended up with a $900,000 mortgage, and the CMHC premium was $30,000. Then you'd add the $30,000 on top of the $900,000 mortgage. So you'd have a $930,000 mortgage at the end of it. You essentially end up with a mortgage that's above the percentage threshold that you've calculated. If that makes sense.
Yes. Okay. So I'd love to do another call with you.
Yeah, it gets a little more detailed.
Yeah, in the weeds we'll get. But is it true that an insured mortgage rate is typically a little less than a conventional mortgage rate? So if it was a conventional mortgage rate was 4.5%, an insured mortgage rate might be 4.2%.
Yeah, so it gets a little complicated. I'm oversimplifying it. They can buy and sell them, and they make money off of the margin of the mortgage. In order for it to be able to be sold as a mortgage-backed security, it has to comply with CMHC's guidelines. And that's why people that have a CMHC insured mortgage get a better rate because the bank is able to make more money, essentially make more money off of that mortgage.
Interesting. Okay. And could they keep that lower rate through the life of the amortization, or would that have to be all renegotiated every 5 years or whenever they renew their mortgage?
Yeah, the terms of the mortgage are exactly the way they would be for any other mortgage. So if you take a 5-year mortgage, it comes up for renewal after 5 years and you renegotiate it. And it's always an insured mortgage at that point, unless they change the amortization.
Okay, got it. All right. Speaking of mortgage rates, should young people or first-time home buyers be worried right now? Things have softened in the marketplace as far as mortgage rates recently. Do you see that trend continuing for the next couple of years, or is everything up in the air right now?
Yeah, we have a lot of first-time home buyers right now out there looking for homes. I tell them the same thing. Today, rates are among the lowest rates. Now, if you're a younger generation home buyer, if you've tried to get into the market in the last few years, rates are higher than they have been. Overall, these rates are very low. I expect that rates are going to stay within this realm. They may go a little bit higher. They may go a little bit lower. We're expecting throughout the year, they may go a little bit lower. But if you're a first-time home buyer, talk to people that have had homes in the years past. They'll tell you rates like 7, 8, 10. Some might even tell you rates of 17, 18 or more. So these are really low interest rates. The only difference is that the housing prices are a lot higher. I know everything's more expensive and people make more money, so everything's relative. But the home price particularly in your market, our market, the GTA, is very expensive. And I think that's probably the biggest reason why first-time home buyers are apprehensive. Rates are not really the issue. It doesn't really matter what the rate is. If the mortgage is $1 million mortgage, it's still going to be a big payment. So I think that's the pushback that people are concerned about right now. It's just the affordability of the houses.
And that's why I always advise, if somebody is pre-approved for a certain amount, I try and push them to go lower, buy a cheaper house, because life's expensive and bills add up. And I know some people push back and say, but I'm pre-approved, I can afford it. But I really try and advise the young people and first-time home buyers to buy the lower price place, just because, yeah, you want to have fun too and travel, maybe.
Yeah. And you know what? If you're buying a home, maybe it needs a new furnace, maybe it needs a new roof. There are things that go wrong in a home, and you want to keep a little bit of reserve just to make sure the utilities, it's not getting any cheaper to heat your home. So these are things, especially until, and this is your world, definitely, to make sure that clients understand this, but it's one thing if you've owned a home and you understand it, you know what you're getting yourself into. But first-time home buyers, I agree with you. If you're approved for a certain amount, maybe take a little step back and get an idea as to what it's like to own a home. And then that way, the next home, yeah, maybe if you want to push it because you understand what you're dealing with. But it's definitely the safer route to go the way you're suggesting.
Yeah, agreed. Especially coming out of a rental situation where you're not paying for all these issues that come up. Okay, you know what? Our time is almost up here. I'm going to stop it there, but I would love to do either more interviews with you, even 10-minute interviews. We can focus on a specific topic at another time. I really love to help the first-time home buyers because I really want to advocate for them to get into this market because it is scary and tough. So if you're open to it, I'd love to do more of this in the future. And I really appreciate your time. Any parting words you would like to drop before we leave?
Yeah, I'd just thank you for having me. I'd love to do more of these. If any of your clients want to send you questions specifically, I'd be more than happy to help explain that. And I think parting words, if you're a first-time home buyer and you want to get into the market, don't be afraid. You need a place to live and it's better than renting. So I always say renting is 100% interest. So mortgages are definitely a cheaper way to go. As long as you buy within your means and play it safe, you should be good.
And build your own equity. Yeah, that's the best way. Okay, thank you, sir. I really appreciate your time. All the best. And anybody is interested or has any questions, let me know and I'll hook you up with Colin. He's the best. All right. Thanks, Colin.
Thank you so much.
All right. Bye-bye.
Bye.